If I ask you to name, like, the absolute cheapest AI stock on the market today,
Mhm.
what would you even start looking for?
I mean, you would probably start looking for some obscure penny stock, right? Like maybe a startup that just went public, or I don't know, some beaten down hardware supplier that everyone completely forgot about.
Yeah, exactly. But what if I told you that the cheapest, like, mathematically safest asset on the entire board right now is Nvidia?
Well, it sounds completely absurd on its face. I mean, the company that has just dominated the headlines for years, right?
Oh, yeah.
The absolute poster child of the whole artificial intelligence boom. Categorizing that as a value play is, it's wild.
It is wild.
Yeah.
But when you strip away all the market noise and actually, run the deep institutional grade math, the numbers tell a story that completely contradicts the mainstream narrative.
Yeah, they really do. And we are going to break down exactly how that math works today.
Right. And just to set the scene for everyone, today is Thursday, May 7, 2026. And we recently got our hands on a really fascinating set of internal notes.
And this isn't just like a generic market outlook either.
No, no, definitely not. We are looking at the exact April 2026 portfolio allocation, the underlying logic, and the real-time action plan of a highly sophisticated systemic tech investor.
Right, someone who operates at the absolute highest level of the hard tech sector.
Exactly. And the real value of these notes, it lies in the architecture of the thinking.
Because most people, they look at a successful portfolio and just try to copy the tickers, like a cheat sheet for a test.
Yeah, but we are going to treat it like a blueprint. We need to reverse engineer the actual physical constraints of data bottlenecks.
And the psychological illusions, right? The things that trick retail investors into thinking a stock is already, quote unquote, priced in.
Right. And how to read the hidden signals buried deep inside those institutional growth estimates. So, okay, let's unpack this.
Because before we can really analyze the broader market, we have to look at the money. We need to see where this master investor is actually placing their capital, to understand their convictions.
Yeah, and you've been digging through the breakdown of this core portfolio, and the weightings are wildly skewed compared to what a casual observer might expect.
Oh, they absolutely are. Like, let's look at the actual capital allocation here. The largest single slice of this portfolio, a full 30%, is not in compute.
Wait, it's not in processors.
No, it's not in the processors. 30% is allocated to optical communication and testing. We're talking about companies like Lumentum, Marvell, and FormFactor.
Wait, 30%. That means they've allocated more capital to the networking equipment, like essentially the plumbing of the data center,
Yeah.
than they have to the actual AI compute engines.
Yeah, exactly. Which is crazy because if you just follow social media, everyone assumes you just buy the GPU makers and, like, go to sleep.
Right.
But then you look at the rest of the board, 20% is in CPU and edge AI, so holding Intel and AMD. Another 20% is in big tech, specifically Nvidia and Google.
Okay, that makes sense.
Then 10% is in pure semiconductors, holding Taiwan Semiconductor. And then a massive piece of the puzzle, 20% is sitting entirely in cash and other liquid assets.
Wow. 20% in cash, and we also see their specific action plan for this coming week, right?
Yeah, they are buying Apple to bet on edge AI and aggressively adding to their Nvidia and AMD positions.
Okay, but the optical allocation is what completely throws me. Let's focus on that 30% block of Lumentum, Marvell, and FormFactor. Why overweight the networking components so heavily in the spring of 2026?
Because this investor, they understand the physical evolution of the technology. The bottleneck for artificial intelligence is no longer the speed of a single processor.
Right.
The math on a single GPU has been solved. The constraint today is how fast you can get tens of thousands of those processors to talk to each other simultaneously without the entire system choking.
Oh, man. Okay, let's visualize this for you guys listening. Think about a high-end restaurant. The Nvidia GPUs are the world-class Michelin star chefs.
I like that.
Yeah, and in the early days of AI, the race was just to get the best chefs in the kitchen, so companies bought thousands of them. But now, in 2026, you have 10,000 Michelin star chefs in a massive kitchen, all cooking at light speed.
Right, but the problem is you only have 2 doors leading out to the dining room and you only have 5 waiters.
Exactly. The food just piles up at the pass and gets cold. The chefs are sitting idle, waiting for the waiters to return.
And those chefs are burning electricity and doing nothing. So Marvell and Lumentum, they are the companies building wider doors and hiring thousands of hyper-efficient waiters.
They're building the multi-lane optical highways that allow the data to actually leave the processor and travel across the server farm.
Because you can have the fastest compute in the world, but if the bandwidth isn't there, the whole system is basically paralyzed.
Right, so the computational phase was phase one. We are deep into the system phase now.
Exactly. Custom chips, or ASICs, they're hitting like a 40% penetration rate in AI servers this year. The interconnects are the undisputed choke point now.
And Marvell and Lumentum specialize in co-packaged optics, right? They build the literal custom silicon that directs this massive traffic jam of light and data.
Yes, but the inclusion of form factor in that 30% allocation is perhaps the most brilliant institutional grade signal in the entire portfolio.
Yeah, form factor isn't really a name you hear on the nightly news. It's deep in the supply chain.
Very deep. They are the invisible champions of the testing phase. And to understand why form factor is so critical, we have to look at how chips are physically built right now.
Okay, break that down for us.
Well, Moore's law, right. The idea that you can just keep shrinking transistors forever, that's hitting physical limits.
Right, you can only make things so small before quantum physics starts messing with the electrons.
Exactly. So companies like TSMC have moved to a packaging method called CoWoS. That stands for chip-on, wafer-on substrate.
Okay, so instead of making one giant flat chip, they are stacking smaller chips on top of each other, almost like microscopic Lego blocks.
Yeah, it's like building a 3D skyscraper instead of a 2D strip mall. But here is the massive risk with stacking chips. If you have a skyscraper of silicon and one single component on the third floor is defective, the entire multi-thousand-dollar package is garbage once it's glued together.
Oh, wow. Because you can't unglue it?
You can't. You have to test every single microscopic connection before the final epoxy is set.
And that is where form factor comes in.
That's it. They manufacture microscopic probe cards. Imagine a card with thousands of hair-thin, highly conductive needles.
Needles?
Yeah, needles that physically touch the incredibly tiny solder bumps on the unsealed chips to run electrical currents through them. This ensures the logic works before the package is permanently sealed.
That's insane. So as advanced packaging expands, form factor's testing equipment is a non-negotiable physical necessity. You cannot build a modern AI chip without testing it first.
Exactly, and retail investors completely ignore these tertiary layers of the supply chain.
Think about your own mental model of this sector for a moment. Are you only focused on the finished product? Or are you looking at the microscopic needles, the fiber optic cables, the infrastructure that makes the final product possible?
Because if you only own the headline names, you are completely blind to the actual physical constraints driving the market right now.
Yeah, and physical constraints dictate market reality. So if we look at this master investor holding these infrastructure stocks at what seem to be demanding valuations, we have to ask why they have such immense conviction that this upward wave hasn't crested yet.
I mean, why not just take the massive profits from the 2024 and 2025 run-ups and just walk away?
Right. We have to move from what they're buying to the actual physics of the why.
Mm-hmm.
It really comes down to a structural shift, doesn't it? The transition from the 800G era to the 1.6T era in optical modules.
Yeah, because in hardware, technology generations act as profit modes. 800G, which stands for 800 gigabits per second, that was the previous gold standard for optical transceivers. And the market has fully digested that build-out. But 2026 is the year of 1.6 terabit mass production. We are talking about doubling the bandwidth.
Moving from the pilot phase into deployments of millions of units.
Exactly.
And to put that in perspective for everyone, we aren't just talking about pushing a software update to make things run faster.
Yeah.
Doubling the data transfer rate physically changes the environment.
It absolutely does.
Like when you try to push 1.6 terabits of data through a transceiver, the amount of heat generated is astronomical.
Yeah, the physics of signal degradation and thermal dynamics become your biggest enemies. The faster the laser pulses, the harder it is to keep the signal clean over distance.
Right.
And the more power it draws, which creates heat that can literally melt surrounding components.
Literally melt them. That's wild.
So companies like Lumentum have to invent new materials in silicon photonics just to make the 1.6T jump physically viable. It requires immense capital and engineering talent, which is why only a few companies on Earth can even do it.
And the penetration rate is the metric that matters most here, right? Our sources note that current 1.6T penetration inside these massive data centers is sitting somewhere between 10 and 15%.
Right. And if you study the historical adoption of any major technology, it forms an S-curve. The adoption starts slow and flat at the bottom as companies test the tech.
Uh-huh.
Then it hits a critical mass, an inflection point, and the adoption rate goes vertical. That is the steep part of the S. Eventually, it levels off at the top when everyone has it.
So the absolute most lucrative time to be invested is right as the technology moves from that 10% pilot phase into the vertical climb.
Exactly. The peak hype cycle, where a stock might actually be dangerously overvalued,
Hmm.
that doesn't usually hit until penetration is somewhere between 30 and 50%.
Wow. Okay. So at 10 to 15%, the physics of the rollout guarantee that the steepest revenue growth is still ahead of us. We aren't guessing. We are looking at the S-curve.
Yeah, and it is backed up by hard physical data. The notes show that Lumentum's backlogs for their optical cross-connect orders are stacked up past $400 million.
Wow. And those aren't projections, right? Those are signed orders stretching all the way into 2027.
Precisely. We can tie that directly to the capital expenditure, the CapEx of the hyperscalers, Google, Meta, Microsoft, Amazon.
So you don't just look at the absolute dollar amount they're spending.
No, you have to look at the second derivative of their CapEx. Are they spending more this quarter than they spent last quarter? The rate of spending is actually increasing.
Right. They are still growing their CapEx at over 20% year over year. So here's where it gets really interesting. The market anxiety we see right now isn't about whether Microsoft or Google can afford to build these data centers.
Right, they have infinite cash.
Exactly. The anxiety is about the physical impossibility of the supply chain producing enough 1.6T modules to satisfy them. They are panicked about getting the hardware delivered, not about paying for it.
And that's why this master investor isn't trying to predict the future. They are observing physical reality, signed contracts, factory backlogs. It's just cause and effect.
It is the difference between hoping the weather is nice tomorrow and looking at a radar screen showing a massive storm front already 10 miles away. You don't have to guess, you just have to watch it arrive.
Perfect analogy.
But this brings up the most common aggressive pushback you hear in finance. If these orders are signed, if the backlog is publicly reported on their quarterly calls, if every analyst on Wall Street knows 1.6T is the new standard, hasn't the market already factored all of this into the stock price?
Like, why isn't it priced in?
Yeah, why isn't all of this quote-unquote priced in?
Priced in is thrown around constantly, usually by people who don't understand market mechanics. To understand why 1.6T is not fully priced in, we have to define what a true priced-in scenario looks like in the wild.
Right, because we see this happen every earnings season, and it always stuns retail investors. A massive tech company releases a flawless earnings report. They beat the revenue estimates, they crushed the profit margins, they even raised their guidance for the rest of the year.
An objectively perfect quarter.
Right, and the stock opens the next morning and instantly plummets 10%.
It's brutal. But that phenomenon is the ultimate symptom of a stock being entirely priced in. The mechanism driving that drop is called the last buyer theory.
Explain that.
Imagine the stock market as a physical room full of people. If absolutely everyone in that room has read the news, believes the company is amazing, and believes the stock is going to go up, what action have they already taken?
Well, they've already bought the stock. They're holding it.
Right. Every single person who wants to be exposed to that asset is fully invested. There is zero fresh capital sitting in their wallets. So when that flawless earnings report drops, it simply confirms what everyone in the room already believed.
So nobody new walks through the door to buy more.
Exactly. But inevitably, a few people in that room decide they want to take some profits. Maybe an institution needs to rebalance, or a hedge fund needs to cover a loss somewhere else. They offer their shares for sale.
But no one in the room is buying.
So the seller has to lower their asking price to tempt someone, then lower it again. The price drops rapidly, not because the company is bad, but because the market has simply run out of buyers.
Wow. So when consensus is at 100%, when everybody agrees, the stock is actually in incredible danger.
Yeah.
Any slight breeze of bad news or even just a lack of overwhelming good news causes a crash.
Yeah. Counterintuitively, you want people to be arguing about a stock. The internal notes mention that high turnover and fierce disagreement, like a brutal fight between the bulls and the bears right as a stock is hitting its high point, is actually fuel for the rally.
Wait, really? Fuel?
Disagreement is the healthiest thing for a stock price. High turnover means the investors who bought in early at a low price, the ones who are getting nervous, are taking their profits and exiting. They are cashing out.
Okay, and who is replacing them?
New buyers who are perfectly comfortable paying the new, higher price.
Oh, I see. It washes out the
It
weekends.
completely resets the psychology of the shareholder base. It establishes a new, much higher average cost basis.
Because the new buyers aren't going to panic and sell if the stock drops 2% because they just bought in. It creates a massive, resilient floor under the current price.
That's right.
Think about how people discuss these stocks in your own life. If everyone on your social media feed is raving about a specific company and they all post screenshots of their massive gains, the opportunity might be gone.
Yeah, that's dangerous.
But if people are acknowledging the stock is going up, but they are terrified to touch it because it looks too high, if they are scared of heights, then the rally still has an immense amount of fuel. Those terrified observers represent future buyers who haven't capitulated yet.
Doubt is the wall that bull markets climb. As long as the doubt exists, the price has room to run. But we can't build a massive portfolio on psychological theories alone. Psychology shifts in a day.
Right. We need a mathematical anchor to verify what we are seeing. We need to transition from the psychology to the raw math. We need to demystify G and understand the PEG ratio,
Yes.
because this ratio is the true North Star for navigating valuations in a high-growth sector.
It really is. So the PEG ratio stands for price earnings to growth. You take the traditional PE ratio, the price of the stock divided by its earnings per share, and you divide that number by the expected earnings growth rate, which is the G.
Okay, so it essentially tells you how much you're paying for every individual unit of growth.
Exactly. It levels the playing field. A company with a PE of 50 might look terrifyingly expensive, but if their earnings are growing at 100% a year, their PEG is 0.5.
Because 50 divided by 100 is 0.5.
Right. They are actually cheaper than a company with a PE of 10 that is only growing at 5% a year, which has a PEG of 2.0.
Let's use the concrete examples from the Master Investor's Notes to illustrate this, because the contrast between two specific companies is wild. Let's look at SanDisk, ticker SNDK, a massive player in memory storage.
Oh.
In our 2026 timeline, SanDisk is recovering from a brutal cyclical downturn. They went from a massive loss of negative $11.32 per share, and they are expected to bounce back to a positive $11.60 per share.
And that bounce represents a staggering 350% growth rate.
So because that 350% number is sitting in the denominator of our formula, SanDisk's PEG ratio shrinks to a microscopic 0.087.
Right. Then look at Lumentum, OUIE, the optical networking giant we just discussed. Lumentum's PEG ratio is sitting all the way up at 3.79.
Wow. Now, traditional financial theory, the kind you learn in Business 101, dictates that a PEG under 1.0 is undervalued, and a PEG over 2.0 or 3.0 is wildly overvalued bubble territory.
Mathematically, SanDisk looks like the greatest value investment of the decade, and Lumentum looks like a disaster waiting to happen.
So why does our master investor have Lumentum as a cornerstone of their 30% core portfolio, while deliberately excluding SanDisk from the main allocation? It seems to fly in the face of the very math we just established.
Well, you have to look past the isolated math and examine the structural integrity of the business model. You have to understand the difference between a deep moat and a shallow moat.
Okay, explain that difference.
SanDisk's PEG is a mathematical illusion caused by a turnaround phase. SanDisk makes NAND memory. And NAND memory, despite all the complex engineering that goes into it, is ultimately a commodity.
A gigabyte of storage is a gigabyte of storage, regardless of whose logo is on the chip.
Exactly the issue. If the global price of NAND memory skyrockets because of AI data center demand, what is stopping a giant like Samsung or SK Hynix from simply spinning up 3 new fabrication plants, flooding the global market with cheap memory chips, and totally collapsing the profit margins?
Nothing. They have every incentive to do exactly that to steal market share.
And that is a profoundly shallow moat. That 350% growth rate SanDisk is posting is a one-time cyclical bounce off the absolute bottom of a terrible year. It is not a sustainable multi-year trajectory.
So the minute the cycle turns and supply catches up with demand, that tiny PEG ratio explodes and the stock collapses. It is the classic low PE trap.
Yes. Meanwhile, Lumentum and Marvell might look mathematically expensive with those high PEG ratios, but they possess near monopolies on highly customized data bottlenecks. They have the deepest moats in the industry.
Right, because Microsoft and Meta can't just call up a random factory in Asia and demand 10 million 1.6T optical transceivers tomorrow.
No, The intellectual property, the patent portfolios, and the specialized manufacturing lines required to build silicon photonics are concentrated in the hands of 2 or 3 companies
Oh,
globally.
wow.
The master investor is choosing to pay a high premium for the durability and certainty of the 1.6T rollout rather than holding a cheap, fragile asset that is completely at the mercy of Samsung's production schedules. You pay for the lifespan of the growth.
That makes so much sense. But if you are an individual investor, how do you manage this tension? You have the safety of a high-priced monopoly on one hand and the explosive short-term percentage gains of a turnaround commodity stock on the other.
It is entirely an exercise in portfolio allocation. You put the deep moats, the Lumentums, the Nvidias in the core portfolio. They are the anchor.
Right.
If you want to speculate on the turnaround, you carve out a small fraction of your secondary capital for the cyclical play. But you do so knowing that you cannot just buy and hold. You have to monitor the spot prices of NAND memory on a weekly basis, ready to eject the second the supply curve shifts.
Armed with this understanding of peg ratios, moats, and the physical constraints of networking, let's bring this to the real-time data. We have the exact stock showdown from mid-April 2026. Let's look at why the master investor is targeting specific names this week.
Yeah, let's run the board.
We start with the undisputed king of the sector, Nvidia,
Wow.
ticker NVDA. In mid-April 2026, it is trading at $201.68. It carries a forward PE of roughly 25x. But its expected growth, the institutional G, is a massive 68.97%.
And you run that math, and the PEG ratio is an incredibly low 0.36.
Let that number sink in. Nvidia is arguably the most scrutinized, heavily debated piece of equity on the planet. The universal consensus from people who only look at the stock chart is that it has run too far too fast and is a massive bubble.
Yeah, but when you apply the PEG ratio at 0.36, it is mathematically the cheapest artificial intelligence asset available.
I have to admit, seeing a stock that dominant carrying a value territory peg is jarring. Like, it doesn't compute initially.
It's because their fundamental earnings engine, their ability to generate sheer profit from these massive GPU clusters, is growing so aggressively that it is physically outrunning the stock price's ability to expand the multiple.
Wow. So the stock is going up, but the profits are going up substantially faster. It is compressing its own valuation through sheer brute force.
That's exactly it.
Let's compare that directly to Microsoft MSFT. It's trading at $422.79. It also has a PE hovering around 25x. But Microsoft's expected growth is only 16.8%.
That puts its PEG ratio somewhere between 1.3 and 1.66, depending on the exact forward estimates. Plus, Microsoft is currently pouring $37.5 billion per quarter into capital expenditures just to keep up in the AI race.
$37.5 billion per quarter. That massive CapEx black hole is creating a massive lag in their profit growth compared to the companies actually selling them the hardware.
Right, this creates what we call valuation divergence. People wonder why Microsoft's stock feels stagnant, even when they announce incredible new adoption rates for Copilot or Azure Cloud Services. It's because institutional money managers are doing the math we just did.
Yeah, so for every single dollar you invest in Nvidia at a 25x multiple, you are capturing over 4 times the fundamental growth rate compared to investing that same dollar in Microsoft at the exact same multiple.
Exactly. Capital is completely agnostic. It flows to the point of highest efficiency. In the spring of 2026, hardware is proving to be infinitely more capital efficient than software.
Then we have Marvell, MRVL. It just hit an all-time high of $139.69. Its earnings per share are growing at a blistering 81%, giving it a seemingly fair peg of around 1.07.
Oh,
But I have to push back here.
go for it.
Buying any stock the exact day it hits an all-time high feels incredibly reckless. I mean, the instinct is to wait for a pullback. Why is Marvell an immediate buy at the absolute top?
Because you have to account for the nonlinear second derivative. That peg of 1.07 is calculated using the current linear expectations of Wall Street analysts. But remember the physical backlogs we discussed?
Yeah.
The master investor knows that in Marvell's upcoming earnings call, they are almost certainly going to revise their data center revenue guidance drastically upward.
I see. The moment management raises guidance, the G in the formula jumps.
And if the denominator jumps, that fair peg of 1.07 instantly compresses down to 0.7 or lower. You are not buying the stock based on what the math says today. You are front-running the inevitable mathematical revision that will happen next month.
Okay, then there is AMD trading at $278.39, holding a peg of 1.32. They have a massive earnings report coming up on May 5th regarding the sales figures for their MI350 chips. My question is, why bet on the runner-up?
Well,
If Nvidia is the undisputed king and mathematically cheaper, why allocate capital to AMD at all?
because AMD is the ultimate Plan B play. You have to look at the psychology of the hyperscalers, the Googles and Microsofts of the world. They are terrified of being completely hostage to NVIDIA's pricing power.
Right. If Nvidia is the only game in town, Nvidia can charge whatever they want, and the hyperscalers' margins are destroyed.
Exactly. They desperately existentially need an alternative to exist. The hyperscalers will throw billions of dollars in contracts at AMD simply to keep a secondary viable ecosystem alive.
So they are actively subsidizing their own alternative to prevent a total monopoly.
Yeah. That dynamic creates an artificial, heavily fortified floor under AMD's MI350 series. It is an industry-wide strategic hedge, making AMD much safer than its technical specifications alone would suggest.
Finally, we have Google, GOG, trading at $339.40 with a PEG of 1.61. They are also facing a terrifying capex burden, expected to hit between $175 and $185 billion for the year.
That is massive spend, and it's absolutely suppressing their immediate profit margins.
But Google holds a very unique physical moat. They have a deployed fleet of over 2 million custom TPU chips.
And this requires a brief detour into chip architecture. Nvidia makes GPUs, graphics processing units. Think of a GPU as the ultimate Swiss Army knife.
Okay.
It is incredibly powerful and can do almost anything you ask of it, which is why everyone uses them to train massive, unpredictable AI models. But Google's TPUs are ASICs, application-specific integrated circuits.
So if the GPU is a Swiss Army knife, the ASIC is a highly specialized surgical scalpel.
Exactly. It is designed to do exactly one math equation perfectly with maximum energy efficiency, and it physically cannot do anything else.
Okay, but because Google uses AI internally for search algorithms and YouTube recommendations, tasks that are highly predictable and repetitive, they can use their own custom TPUs instead of buying expensive NVIDIA GPUs for everything.
Right, so their peg looks a bit high, but that internal TPU fleet heavily insulates them from the wider supply chain bottlenecks tearing the rest of the industry apart.
So what does this all mean? When you synthesize all of this data, it forces a complete paradigm shift in how we view the market.
It really does.
NVIDIA, the darling of the retail hype cycle, the stock that traditionalists refuse to touch because it looks too expensive, is structurally and mathematically the cheapest asset on the board. It completely inverts the definition of value investing in a hyper-growth environment.
Right, because a high share price is completely irrelevant if the earnings engine underneath it is expanding at an exponential rate. However, there is a massive caveat to this entire discussion. This elegant mathematical certainty only works in a vacuum. And the stock market is not a vacuum. The real world is governed by macroeconomic forces that do not care about your elegant PEG ratio.
Which brings us to the most conservative, defensive element of the master investor's entire strategy. If NVIDIA is a mathematical certainty, why doesn't this investor put 100% of their capital into it? Why not take out leverage and max out the position?
Right.
We have to examine the philosophy of holding cash. Because despite all these incredible setups, this investor is holding a full 20% of their portfolio in cash.
And that 20% cash position is the most critical lesson for anyone listening. We are operating in a highly specific macroeconomic climate in 2026. Interest rates are locked in above 3.5%.
Yeah.
Inflation has proven to be sticky. The decade of 0% interest rates, the era of free money, is definitively over.
And high interest rates present a very specific systemic danger to growth stocks, right? Yeah. The threat of a D-rating.
A D-rating is the silent killer of portfolios. It happens when the broader market suddenly decides to systematically compress the PE multiples across the entire tech sector, regardless of individual company performance.
Let's use some simple math to explain this.
Okay, let's say a stock earns $10 a share and the market gives it a 25x multiple. The stock trades at $250.
Makes sense.
Now, a bad inflation report comes out. The Federal Reserve hints they might raise rates again. The market panics and decides that risk assets should only command a 20x multiple, not 25x.
But the company is still making the exact same $10 a share. Their business is flawless.
Exactly. But at a 20x multiple, the stock price instantly drops to $200. You just lost 20% of your wealth purely due to macroeconomic fear.
Oh man, so the 20% cash allocation acts as an umbrella against that exact macro shock.
Yes, cash serves a dual purpose. First, it is a structural and psychological cushion. If the broader market violently drops 15% in a week, your total portfolio drops significantly less because a fifth of it is perfectly insulated.
It protects you from margin calls. And more importantly, it protects you from the sheer psychological panic that causes retail investors to sell everything at the absolute bottom of a dip.
But the second purpose is offensive. That cash is dry powder.
Ammunition waiting for the math to break in your favor.
Exactly. If a macro shock drives Nvidia from $201 down to $170 out of pure generalized fear with absolutely no fundamental bad news from the company itself, that already low peg of 0.36 plummets to a mathematically absurd 0.29.
So the cash umbrella allows the master investor to completely bypass the institutional panic. When massive mutual funds are forced to liquidate their holdings just to meet customer redemptions, our master investor calmly steps into the chaos and buys the dip.
Anchoring their decisions on the cold, hard physical data of the 1.6T network buildout. Furthermore, Nvidia is the ultimate high-rate safe haven.
Because they currently boast a 4.2% free cash flow yield, they are generating rivers of pure cash.
Right. When interest rates are high, companies that have to borrow money to grow are punished. Nvidia doesn't need to go to a bank to fund their next generation of chips. They are entirely self-sustaining.
Think about how you react when your favorite stock drops 15% on a random Tuesday. Your gut reaction is panic, right? You stare at the red screen and wonder if you should cut your losses.
It's terrifying for most people.
But if you are sitting on 20% cash, suddenly that red screen doesn't look like a threat. It looks like a clearance sale. Without cash, you are a hostage to market volatility. With cash, you are a predator taking advantage of it.
It is the defining difference between surviving a market cycle and violently capitalizing on it. But to execute this properly, to know exactly when to deploy that cash, you have to know how to read the institutional research reports without getting manipulated by them.
So we have to learn how to read the matrix. How do we navigate the institutional growth estimates? Because according to these notes, Wall Street institutions are notoriously terrible at actually predicting specific growth numbers.
They are. They are excellent at predicting macro directions. They know if the financial weather is generally getting warmer or colder, but they are historically awful at guessing the exact temperature.
And this failure stems from two inherent flaws in their models, right? Linear extrapolation and herding effects. Break those down for us.
Okay, linear extrapolation is the trap of looking at the recent past and drawing a perfectly straight line into the future. If a company grew its revenue by 20% last year, the analyst will confidently model 20% growth for next year.
They completely miss the explosive nonlinear inflection points, like the sudden vertical adoption curve of 1.6T optics. The real world doesn't move in straight lines, it moves in leaps.
Exactly. And the herding effect is just job security, right? Nobody wants to be the one rogue analyst predicting 80% growth when the rest of Wall Street is predicting 30%.
Because if you are wrong while standing with the crowd, you keep your job. Everyone was wrong together. If you are wrong while standing alone, you get fired.
So analysts inherently huddle around a safe, conservative, ultimately useless consensus.
If the absolute numbers they publish are useless, what do we actually look for in these reports? We look for the second derivative of the estimates. We look at the earnings revision trend.
Right, you don't look at the static number. You look at the direction the analysts are frantically trying to adjust the number. Are they constantly having to revise their estimates upward just to keep pace with reality? If so, the company is fundamentally outperforming the models.
But you have to be incredibly careful to avoid the catch-up downgrade. In Chinese markets, they call this budai. It is infuriating to watch.
It is the most useless piece of research on Wall Street.
It's like a meteorologist breaking into a live broadcast to issue a severe thunderstorm warning while you are already standing in your flooded living room looking at your ruined couch.
That is a perfect analogy. A stock will crash, say it falls 50% over 3 months because the physical supply chain data deteriorated. The damage is entirely done, the stock has bottomed out, and then, only after the dust has settled, an analyst puts out a flashy report downgrading the stock from buy to hold simply to match the new, lower reality of the share price.
They're just covering their own tracks for compliance reasons.
Those reports offer zero predictive forward value. If you sell your position based on a catch-up downgrade, you are selling at the exact microsecond that all the bad news has finally been fully priced into the stock. You are selling the bottom.
To avoid relying on these deeply flawed analyst models, the master investor uses a mental trick called reverse DCF, reverse discounted cash flow.
It is a brilliant way to reframe the problem. A standard DCF requires you to build a massive spreadsheet, make dozens of assumptions about the future, and try to guess what the stock is worth.
Yeah.
A reverse DCF turns the formula upside down. You take the current stock price, which is a known fact, and you work backward to figure out what growth rate the market has already baked into that price.
So imagine you open your app and see Nvidia at $200. You don't ask, what will Nvidia be worth in 5 years? You ask the math. Based on today's $200 price tag, what percentage of growth is the market currently expecting?
Let's say the reverse math reveals the market has priced in a 40% growth rate. You no longer have to predict if Nvidia will grow 65% or 75% or 80%.
You simply have to ask yourself one binary question. Based on the physical data centers being built right now, can Nvidia beat 40%?
And if the answer is an obvious yes, the stock is inherently undervalued.
It drastically simplifies the decision tree. It helps you instantly spot the difference between a value trap and unpriced good news. If a company raises its guidance, but the stock stays perfectly flat, you immediately check the PE ratio.
Right.
If the PE is sitting at historical highs, that good news was already expected. It was priced in. But if the PE is at historic lows, the company raises guidance, and the stock still refuses to move.
That is the signal. That means the broader market is violently mispricing the asset purely due to macroeconomic fear or temporary distraction. That dislocation between reality and price is the golden opportunity.
So for everyone listening, when you open your brokerage apps tomorrow, ignore the analyst price targets completely. They are lagging indicators. Instead, look for the physical metrics.
Yes. Look at inventory days. Are finished chips piling up in warehouses, or are they flying out the door the second they are tested? Look at the capex of their largest customers. Are the hyperscalers still spending billions on infrastructure?
And check the earnings surprise history as the company consistently beating the consensus estimates quarter after quarter.
Because if the physical, real-world data remains exceptionally strong, but the market price is dropping due to generalized fear, that is the exact moment you deploy your cash umbrella.
We have covered an immense amount of ground today. We have thoroughly reverse-engineered the master investor's blueprint. We explored the deep physical constraints of the 1.6T networking era, examining why optical infrastructure and advanced packaging testing are the new, true bottlenecks.
We dismantled the psychology of the last buyer theory and why universal consensus is the most dangerous thing in finance.
We demystified the PEG ratio to reveal why mathematically expensive-looking stocks are often the cheapest assets on the board. And we outlined how a strict 20% cash allocation allows you to ruthlessly exploit institutional panic.
But if we zoom out and connect all of these pieces to the macro picture of the next decade, this raises one final, absolutely massive question.
Lay it on us.
Everything we have unpacked today, the microscopic probe cards, the co-packaged optics, the CPUs, the highly specialized ASICs, it is all focused entirely on data transfer, compute logic, and physical silicon. But as these hyperscalers deploy hundreds of billions of dollars to build these colossal AI factories, they are building facilities that literally require the continuous power output of entire small cities.
That's a great point. The power draw of a 1.6T transceiver cluster is exponential compared to the previous generation.
So the provocative thought I want to leave everyone with is this. What happens when the fundamental physical bottleneck shifts away from the silicon industry entirely?
Oh, wow.
What happens when the constraint is no longer how fast a custom chip can process data, but whether the local municipal power grid can physically deliver enough electricity to keep the servers from shutting down?
Will we see blackouts caused by data centers?
It is a profound structural risk. Is the next iteration of this master investor's portfolio, the blueprint we will be analyzing in 2027 or 2028, going to be dominated not by semiconductor manufacturers, but by energy infrastructure?
Like advanced cooling system engineers, liquid cooling patents, and next-generation newly powered deployments. Well, when the fire hose of artificial intelligence data requires a literal fire hose of electricity to function, the entire investment landscape shifts underneath our feet once again. Keep digging into the supply chains. Always question the consensus and hunt for the physical bottlenecks. Enjoy the deep dive, and we'll catch you next time.